Picture yourself generating money in the stock market without ever having to purchase any shares. Is it real? It seems too wonderful to be true. Here, I'll walk you through the process of selling options like an expert. You will learn all you need to know to begin generating money with options now by the time this video ends. Is it dangerous to sell options? Is it something that anyone can do? What is the first step? We will address all of these concerns and more if you will just remain with me. We'll jump right in. What is selling options? Imagine earning money from stocks without ever owning any. Sounds quite unusual, right? Still, that's the beauty of options. Let's make sure we know what options are and how they operate before we start on how to sell them. Options are financial agreements allowing you the right, but not the duty, to purchase or sell an asset at a designated price on or before a certain date. You might be wondering right now, why would anyone want to buy or sell something like this? Now, here's the deal. Selling an option is effectively giving someone else the right to purchase or sell a stock at a specified price, and you get compensated for it. But precisely how can this assist you in your income generating? And why might someone wish to purchase an option from you? Stay with us. As we progress, we will clarify all of this and more. How does it work? Choosing to sell an option assigns you a somewhat definite position. You start to function as the option writer or option seller. This implies before a certain date, you are giving the buyer the right to purchase or sell an underlying asset, usually a stock, at a specified price, sometimes known as the strike price. Here's where it gets fascinating. The buyer pays you a premium for this right. Why would someone choose to purchase this right? It is straightforward. Whether they are purchasing a call or a put option, the buyer thinks the price of the stock will either rise or fall, and they want the freedom to benefit should that prove to be true. As the seller, you are paid in advance and in exchange. Should the buyer choose to exercise their option, you run the danger of having to satisfy it. How do I make money from this, and what kind of risks am I dealing with? You could now be asking yourself. Stick with us, since we will dissect it all for you. Different types of options. Examining the two primary forms of options, call options and put options, helps us to truly grasp selling options. Though each type serves as a somewhat distinct function, both are somewhat comparable. First, let's consider call choices. Before the option expires, a call option lets the buyer purchase an underlying stock at a designated strike price. Selling a call option means that, should the buyer choose to exercise their option, you are consenting to sell that stock. Should the stock price rise, the buyer will probably wish to exercise their option and purchase the stock from you at the reduced strike price. You will thus be compelled to sell the stock at a price below its market value. Conversely, put options let the buyer sell an underlying stock at a designated price before the option expires. Selling a put option means that, should the buyer elect to exercise their option, you are consenting to purchase the stock. Should the stock price decline, the buyer would most certainly wish to exercise their option and sell the stock to you at the higher strike price, therefore resulting in a loss to you. You now understand the fundamentals of call and put options. But you might be wondering, what happens if the stock price doesn't move the way I expect it to? Stay around, since even if the stock price doesn't change, in the following part we will discuss how you might really profit from these options. The methodical process of selling options. Though at first confusing, selling choices are not something to worry about. We will dissect it methodically to make sense of it. You have to start with choosing a stock. Selecting a stock you know well and can live with is quite vital. Ideally, you want a stock you think will remain rather constant or with consistent price movement. Since it raises the possibility of the option being used, extremely volatile stocks are the last thing you want. Selecting a strike price comes second once you have decided on a stock. The striking price is the price the buyer may purchase or sell the stock at. Consider how likely you think the stock is to reach your strike price while deciding upon it. Should you be selling a call option, you want the stock price to remain below the striking price. Should you be selling a put option, you want the stock price to remain above the strike price. You finally have to decide on an expiration date. Options are time sensitive, hence they only last for a given period. The expiration dates of most options span from a few days to many months. You should pick an expiration date that fits your expectations regarding the movement of the stock. How do I know which strike price and expiration date to choose? You may now be asking. Well then, let's address that. So keep with us. How to make money selling options. Collecting a premium is the sum the buyer pays you for the right to buy or sell the stock at the strike price. You make money selling options. The premium changes based on elements including the price of the stock, the strike price, the expiration date, and stock volatility. Should the buyer choose not to use their option, you retain the premium as profit. But should they do, then what happens? As the seller, you still have the opportunity to profit as long as the stock stays mostly in the correct direction. Too far in the other direction would mean nothing. But suppose the choice expires worthless. Does that mean you are free to keep the premium without any activity? Indeed. Selling options can be rather enticing for this reason, among others. It's like getting paid without ever having to sell the stock. Still, there's a drawback. Should the stock price veer too far in the direction the buyer was hoping for, you would have to meet your obligation and suffer losses. You might now be wondering, how can I forecast which way the stock will move? Stay with us as we will walk you through several techniques to enable wise decisions. What are the risks? Selling options has some hazards. If the stock migrates too much in the direction the buyer was looking for, you could thus find yourself losing a sizable sum of money. For instance, you might have to sell the call option at that lower price if the stock price increases over the strike price. In the same vein, should you sell a put option and the stock price declines, you might have to pay more than market value for the stock. Big losses can follow from these situations. How therefore might you guard yourself? We will then explore several strategies for controlling risk. Risk management. Self-protection strategies. Using covered calls is one of the easiest strategies to lower risk while selling options. A covered call is a situation whereby you already possess the stock you are selling the option in. You could sell a call option on 100 shares of a stock, for instance. Should the stock rise, the buyer may use the option, yet you still have stock to sell to them. Using protective puts is another really common risk-reducing technique. Purchasing a put option on a stock you already own counts as a protective put. This means that should the stock price decline, you are entitled to sell it at the strike price, therefore reducing your losses. You now most likely wonder, how do I know which strategy to use? Not to panic, we will dissect that in a future part. Best time to sell options. Selling options is best when you think the stock will stay inside a given price range and the option will expire useless. Here you turn a profit by gathering the premium without any effort. How therefore can one find out when a stock will remain inside a range? You could thus take advantage of signals such as previous price movement, market trends, and volatility of the stock. The great question now is, how can I predict stock price movements accurately? Stay with us to see just how to locate these prospects. Common mistakes to avoid. Though it has certain difficulties, selling options can be profitable. Beginners often make several basic errors, including not having a strong exit strategy, not completely understanding the dangers, or selling options on stocks they do not know well. One should also avoid over-leveling oneself. Simply because you are able to sell several options does not mean you should. Starting small and then expanding is crucial as you grow more experienced. Final tip. Although selling options can be a fantastic source of money, they also call for strategy and careful preparation. Always do your stock homework. Start with small positions to control your risk, and apply risk management techniques including covered calls or protective puts. Most importantly, also be patient. Wait for the proper chances to present themselves. Do not hurry into trades. Thanks for watching. Following these guidelines and avoiding frequent errors will help you to start your road to effective option selling. Stay disciplined, keep studying, and you will notice benefits. If this video proves useful, remember to like, share, and subscribe for further trading and option advice. See you next time.